You are listening to Mining Stock Education.
Why would gold be topping when GDX and SIL are about to explode to the upside in the third wave? It just doesn't make any sense. So the better interpretation is probably that gold is also exploding in a third wave, continuing to lead the miners higher. You will look back, decades from now and say, yeah, that was a commodity bull market and gold was leading it the entire time.
In today's show, you're going to hear from an analyst that believes we're facing a multi-decade gold-led commodity bull market. Joining me is Mark Galasiewski. He is with Elliott Wave International. Mark, thanks for coming on the show. And you're going to walk us through some slides. You're going to lay out from a chartist technical perspective why you believe this is the case. Please take it away.
Okay, great. Thank you, Bill. Thanks for having me on the show. My name is Mark Galasiewski, and I'm the editor of the Asian Pacific Financial Forecast at Elliott Wave International, which is a U.S.-based publishing company. And my publication, again, Asian Pacific Financial Forecast, I've introduced to my subscribers at the end of last year in October a thesis that I call the end of the infotech era and the rise of emerging markets. And basically, in a nutshell, it is that the infotech sector, which we can consider the NASDAQ 100, the Mag 7 stocks, but even cryptocurrencies, because it's basically an offshoot, a byproduct of the infotech sector, are coming to the end of their investable era of the past 15 years. And at the same time, what's happening, it already began in the year 2020, and that is the rise of the commodity markets and interest rates. In fact, both of these asset classes are in supercycle advances. And the transition between the period is happening before our eyes, right? We're seeing infotech, the NASDAQ 100 has recently crashed, and we're still waiting for the fall of Bitcoin and the cryptocurrencies markets. But basically, the writing is on the wall that the new trend for the future over the next 10 years and probably longer, perhaps even a few decades, is going to be tangible assets, not intangible assets, infotech, but tangible assets. And so therefore, gold, which is leading the commodity bull market, is a great indicator of what's going to be happening. And of course, emerging markets, one of my specialties as focused on Asia and such, is also going to come along for the ride. So therefore, I'm calling my thesis the end of the infotech era and the rise of emerging markets. And if you don't mind, unless you have any questions about that overview, and feel free, by the way, to ask me any questions, because I'm sure if you have questions, many people in your audience will also have questions as well.
That sounds great, Mark.
Okay, great. Thanks, Bill. So without further ado, let's get to the charts. Here we have on the top, GLD as indicating gold, and two other asset classes. Again, MXI, the iShares Global Materials ETF, an ETF of commodity producers, and EEM on the bottom, the iShares MSCI Emerging Markets ETF. Gold's breakout in 2024 was probably as significant for the rest of this group and for commodities as a whole, as was the NASDAQ's breakout in 2012 and the rise of course, Bitcoin in 2009. So, and it's an exciting time. You can see that these asset classes, the producers, of course, gold, the inflation indicator, and emerging markets have ebbed and flowed with each other for a very long time. You can see just in the past, 15 years or so here, but over time, as we'll see later, a great move up in commodities is also a great move up in emerging market stocks. So without further ado, let's get to our methodology. At Elliott Wave International, we base our forecasts on patterns, long-term patterns, short-term patterns that were discovered by a man named Ralph Nelson Elliott. He called his discovery the wave principle at the time, but in retrospect, the industry now knows it as the Elliott waves or Elliott wave analysis. And the basic idea that, again, Elliott was an American accountant in the Depression. He was charting the Dow Jones Industrial Average by hand. And in a process of doing that, he discovered there were prices patterns that repeated over and over again at different degrees of trend, different degrees of magnitude, smaller and longer term. To show you an example of that, here we have what most people understand to be an Elliott wave, right? You've got a 5-wave advancing pattern labeled with numbers, labeled 1, 2, 3, 4, and 5, followed by a 3-wave corrective pattern or regressive pattern labeled with letters A, B, C. And this pattern has a feature of it is that every basic Elliott wave pattern it not only has subwaves, but it also is a subwave to a larger pattern. So in this case, this 5-wave advancing pattern followed by a 3-wave correction is the initial up-down sequence within a much larger advancing 5-wave pattern. And you can see here that this, this up-down sequence has become the 5-wave pattern to a larger pattern followed by the corrective. And you can imagine that at 1 degree higher, there would be another developing wave, right, in circle wave 1 and 2. That would be followed by an explosive move to the upside in a blue wave 3 up after the end of this wave, what we would call wave 5 of C of 2 down. And so that would be headed higher next. And of course, Elliott didn't have the terminology at the time, but we now know this idea of patterns that are embedded inside of each other, that are similar to each other. We now know it as a fractal, right? In this case, a self-similar fractal. And as an example of how to use this knowledge, this discovery of Elliott's, I'm going to show you something here from India. This is my first few months on the job during the global financial crisis of 2008. Here I was looking at, and again, just bear with me for a moment. I'm talking about Indian stocks, but the pattern and the relationships I'm about to tell you and show you are very relevant to our discussion of commodities and later of gold. So please bear with me on that. But here we have in 2008, in the belly of the beast, global financial crisis, I was looking at this chart, as you can now, and you can see that there is a 5-wave pattern that had played out from the 2003 low down here up to the 2008 high, and then a 3-wave decline down to that global financial crisis low at the time. And here is the analysis I published then. Here it is. The market is a fractal, the 5-wave advance. Another feature of this pattern was the self-similarity of this correction, right, and the advance as well, compared to the prior wave 1 and 2. You can see that in the red box, you've got a wave 1 and wave 2, and that was very similar to the larger wave 1 and 2 from 2003 to 2008, down to the 2008 low. Both of these second waves retraced approximately 50% of the prior advance, their wave 1 equivalents, and as did this, you can see this one down here, retraced 50%. And so therefore I was looking and I forecast an explosive move in what we would call a 3rd wave to the upside, right? And here it was. I forecasted, quote, Indian stocks are about to begin primary wave 3 of the bull market that began in 2003. And let's look at the subsequent price action since then. Here we are. Indian stocks are about to begin primary wave 3 of the bull market that began in 2003. And look at the explosive move after that. Here, several months later, after the retest of the low successful and the follow through on the upside, I had this pattern, and the self-similarity of the pattern compared to the prior wave 1 and 2 move gave me the confidence to go on India's CNBC TV affiliate, TV 18 it's called, and called for Sensex 100,000 within 15 years. And that's been pretty much what has happened. Again, all the squiggles along the way, I can't say that I anticipated all of those, but I've been bullish the whole way. And you can see that in 2024, we came as high as 86,000 on the Sensex, and it has, you might say, okay, Mark, you didn't hit your 100,000 target within 15 years. I'd say, yeah, but give me some credit. That was pretty good, considering the bearishness at the time back in 2008 and early
Mark,
2009.
A quick question about the Elliott wave template. How does it differ than WD Gann in what's employed there? Because that's a cycles approach too that looks at human psychology. Are there some key differentiators with this template?
I'm not that familiar with Gann's work, so unfortunately, from a technical perspective, I can't answer it. But we do know that there are various approaches, and what they all have in common is human behavior. It's mass psychology that is creating this. And what's extraordinary is that, as Gann was showing, these things happened over very long periods. And as we also, as I'm showing here, these patterns play out over very long periods. And the question is, why do those things? That's a question we can't actually answer yet. It's still in the realm of the unknown. There's, why do human beings, their trading impulses, why do they occur, decades after a pattern began, such as here in the Sensex, and I'm sure Gann was working with multi-decade patterns as well, yeah, it has that at its similarity, the mass psychology as being the cause of all of these patterns. But I'm sorry, I can't answer, regarding Gann in particular.
Thank you.
Yeah. Okay. So yeah, I think that this pattern will continue to play out. We'll probably get to around the 100,000 level sometime in the future over the next few years. It's taking a little bit longer than I expected, but in general, this is a good example of how you can use these fractal relationships. Right? Here we're looking at wave 1 and 2, and now wave 1 and 2, an explosive move to the upside in the third wave. This is the power of Elliott wave analysis, and I think one of the best examples out there, at least in my collection. Right. This pattern is called an expanded flat. It's a three-wave decline labeled ABC, where wave B rises to a new high above the start of wave A until it finally crashes down in wave C. And for the technicians in the audience, wave A needs to be 3 waves, wave B 3 waves, and wave C needs to be 5 waves. The 5-wave, in this case, 5 waves down. 1, 2, 3, 4, 5. And now let's apply that to commodities. Here is on the top the Bloomberg Commodity Index. Actually, before we do the actual application of the analysis, let me give you some background to my thesis here. Again, back in early 2020, February 2020, during the coronavirus crash, remember that one, I was looking at this pattern that I'm about to explain, the expanded flat correction in the Bloomberg Commodity Index, and using that, I was able to identify that the index is likely to continue falling to the 60 to 64 range. And the actual low, which occurred a few months later, was at 58.87. Again, it's not pinpoint accuracy, but this analysis and this methodology, Elliott waves, gives you the ability to target within a general range sometimes, and even a tradable range, to identify opportunities. And we continue falling right here. I waited a few months or several months, but by September, the target was reached. I said target reached, bear market over. And since then, you can see that we've had a great move up in commodities. Let me also point out that the sideways correction in the Bloomberg Commodity Index lasted 40 years. And during that entire period, you had U.S. 10-year bond yields also declining in a disinflationary trend. But toward the end of that, here in September, at the same time that I'm saying that the bear market is that in the commodity index is over, I'm also saying forecasting enormous upside for commodities, price inflation, and interest rates in coming decades. Why? Because you can see over time that these two markets, two asset classes, have trended together with each other. And, so I figured, okay, we're going to have a bull market in interest rates as well. Now let's go to the analysis. Why was I so bullish back in 2020? Why did I believe that the commodity bear market had ended? And that's shown right here. You can see the Bloomberg Commodity Index from 1962 traced out a 5-wave advance, right, to the 1980 high, which I believe to be, or in this case, Roman numeral wave 1, up of a much larger pattern, right? Roman numeral wave 2 was the expanded flat correction. Wave A down is 3 waves, wave B up is 3 waves, and wave C down, right, is 1, 2, 3, 4, 5 waves down to complete this Roman numeral wave 2, which we call cycle degree. And again, during this entire period, U.S. 10-year bond yield had declined to the 2020 low. But and over, if you're forecasting a large third wave like I am here, this Roman numeral wave 3 up, which I think has already begun and it is in its early stages, you're probably going to get a very large move up in interest rates as well. And again, the 70s, the 1970s, the period of the 1960s and 1970s shows that wasn't, these two asset classes did not move in lockstep with each other, right? But by the end of the period, you say, okay, yeah, there must have been some relationship, that it's kind of obvious. And it's interesting that the commodity bull market here, this wave B advance, did not result in a corresponding move up in interest rates. But I think that's because the entire correction needed to end first. And so anyway, all of that evidence points to a super cycle advance in commodities and interest rates. And now let's get to another feature of this. Again, we were talking about the Sensex fractal, right, in Indian stocks, how the larger degree second wave was similar in form to, there it is, the smaller degree, right? This previous second wave right here, we've got an ABC correction that is basically similar in form to this larger second wave. And this is just like the India fractal gave me confidence to be very, very bullish about a third wave going forward. This is the same pattern playing out here in the commodity index. And what it implies is a massive third wave advance that's going to last decades. And here's the evidence for that. You can see basically in blue on the left, you can see wave 2 is a fractal iteration, a copy of wave 2 of 1 down here. That's the language we use at EWI. But look at this UR here, right? This is the approximate juncture that you're at. If this is the wave 2 here and this is the wave 2 here, well, we have at this 100 level on the index, we're approximately down here, the equivalent level in this wave 3 advance, this large wave 3 advance. And it took 5 years to get from the 2020 low to where we are now. Right. And if that 5 years is what this took, to get to this comparable location within this wave 3, well, then how many years is it going to take to get all the way to the end of wave 3 if this is the comparable wave 3 over there, right? You've got an 8-fold multiple. 5 years here. It took 40 years to complete what took 5 years over here. That's an 8-fold multiple there. I wouldn't be surprised if we also have another, 8 or several fold multiple in order to get, and that implies several times the 5 years that we've done. So that's why I'm saying that we've got a bull market in commodities and probably interest rates that's going to last at least a few decades.
And Mark, just to point out for listeners, there are those that expect stagflation and inflation of the 70s, and that'll be positive for gold and commodities. And I know that some of them expect that, a 3, 4, maybe 5-year move, but using this template, which you're not factoring in macro analysis necessarily or the actions of governments, you're just looking at past behavior as indicated by the charts and then overlaying that and deducing this multi-decade gold and commodities run, right?
That's correct. That's completely correct. And we at Elliott Wave International, we don't base our forecasts on any political considerations, any fundamental considerations for that matter, because we believe that the mass psychology itself is creating these patterns. And it's going to play out regardless of who's in power, for example, at the head of the United States, in the presidency. These patterns would play out if Kamala Harris had won the 2024 U.S. presidential election. It's not because of the tariffs. It's just simply, the fractal similarity for me, and again, there's a lot of people who would say, well, you're seeing what you want to see in the charts. And I will say, yeah, it worked in India and it's going to work again. It has been working already. This is really powerful stuff and it's really convincing as far as I'm concerned. But, I guess...
So you're saying it's predictive, not just explanatory. You can't just retroactively look back and see it. You're saying, well, if you can see the pattern emerging, then it becomes predictive of what we can expect.
That's correct. And this, at a philosophical level, I'm sure this is going to challenge a lot of people because what it means is that these historical trends, because frankly, you have a massive bull market in commodities, right? It's going to have implications for society, right? And and this is what we believe at Elliott Wave International. We're actually forecasting dire times ahead, and that is something that you need to prepare for. And you can do that, of course, by investing in things that are going to benefit from that, such as gold, for example, or commodities or emerging markets. but again, yeah, it is difficult for many people from a philosophical perspective to say that, it doesn't matter. The policies of the governments of the future are impotent, right? They were unable to stop this trend from occurring, this expansion in commodities. But that it's I don't know. I mean, I'm comfortable with that because I think that I believe in cycles and I believe that history repeats.
Have you read the book The Fourth Turning with Neil House?
I've heard about it, have not read it myself, though. If you want to, please do tell.
No, I'm not an expert on it, so I don't want to misrepresent his view. But it uses human psychology, patterns of behavior, and there's cycles of unrest as it relates to governments, and that impacts the economies of the world and pricing and so forth. But when you say you forecast dire times ahead, are you seeing that because you can see price inflation, you can see commodity inflation, so there's going to be chaos? You can deduce there's going to be chaos in the world when you have those things on steroids.
Yes, exactly. And if you get the financial environment correct in your forecast, you've basically got the social forecast correct as well. And, we've actually got a long history. I mean, Elliott Wave International's founder and president, Robert Prechter, in the late 1970s was, basically alone on Wall Street in forecasting, the greatest boom that the United States has ever experienced. Everybody remembers Business Week magazine's famous cover in 1979, The End of Equities, right? That was the environment of the time. And yet you can, even alone, you can, by yourself, working alone, you can come to these conclusions and say, yeah, there's going to be great times ahead. There's going to be a golden age ahead. But unfortunately, at this period of history, precisely at the end of the golden age of the past 15 years that we have experienced in the United States in infotech stocks, it's actually appropriate to begin to forecast a dark age. And a lot of people are probably uncomfortable with that. But I think that is the great insight that Ralph Nelson Elliott, allowed through his discovery of Elliott waves.
Interesting. All right, you want to progress with your analysis here? And now you got us hooked?
Okay, all right. So the dire times ahead with commodities rising. And right, let's now talk about gold. This was a chart I published on November 4th last year. 2022, more than about 2.5 years ago. And it's another example of how to use Elliott waves. This is the same expanded flat pattern that we were talking about earlier. I was saying gold to end correction, and another additional piece of evidence to support that I had was that wave C, as it sometimes does, approximately equaled or would approximately equal wave A, in this case on a daily closing basis in points, right? So you got wave A down and up to the wave B high. Now this spike, that intraday spike, I forget what it was regarding, but it ended the day here. That's the closing point, is for your technicians, is often a point at which you want to begin, calculating your relationship. So from that point down to this blue line is where wave C would have equaled wave A. And so I'm here, all of this evidence, this expanded flat correction, the relationship between wave C and wave A was telling me that gold was about to end the correction. And let's look at the results since then. Gold has since risen 97%. This morning it's again popping. Now I think a lot of your listeners are probably curious as to what, the technical perspective is on gold at present. And I have to admit, we have seen over the past several months a momentum divergence. On the bottom here, we've got the RSI, or relative strength indicator, and it is failing to keep pace with price. In other words, the gold price has risen above its 2024 high, and whereas the momentum indicator, has not. And as we saw back here, this can be an indication of a turn. You can see in early 2023, we saw the same thing. The momentum failed to keep pace with the price as gold continued rising, and that preceded this 6-month correction or so. So I would not be surprised to see that happen again. However, this is where it starts to get muddy. Many of these momentum divergences often fail. And that may be what's happening now. This move that we've seen, particularly in the past 2 weeks, may be a game changer. And if we continue to advance without seeing a significant correction, then that's probably an indication that this momentum divergence is going to fail. And in fact, that scenario would be very much in line with the longer-term view, which is the thing I'd really like to focus on in my presentation today. I really don't care if gold falls by 20%. It doesn't matter to me, because from the long-term perspective, this is what I believe is actually going on. And here, this is the long-term multi-decade pattern in silver and gold. And from the 1950s, they both traced out to the 1980 high. A wave 1 advance followed by a wave 2 decline into the 90s. And since then, we've been tracing out another series of wave 1 and wave 2 advances, right? Here, what we call a series of 1s and 2s that tends to lead toward an explosive move to the upside, as I think may be occurring here. And we may be right in the early stages of it. And that's, from an Elliott wave perspective, this pattern is called a third of a third of a third of a third wave. So a third wave extension, a third wave extension. In the middle here, you can see this basic 5-wave pattern, right? Wave 1, 2, 3, 4, 5. That is the third wave of this larger pattern from back here, 1, 2, 3, 4, and 5, which is the middle of this not bracketed, but circled pattern, wave 1, 2, 3, 4, 5. So if I'm correct, gold is exactly in that, approaching the middle of that location. Here you have, all of the dates that we know and love: the 1980 high, the 1999 low, 2011, 2015, 2020, 2022. And we're about to explode to the upside in this third of a third of a third wave. And again, it's a great time to be analyzing gold, a great time to be invested in gold. And it's just remarkable. Now, that doesn't mean that over the next several decades that we're not going to pull back, right? We know that over it's nearly a lifetime that this super cycle advance has been going. But there are multiple pullbacks along the way, and there will be, right, in the future. But right now, it's pretty much smooth sailing until we get to the end of this wave 3, which could be several years in the future. So another piece of evidence that I'd like to present to support that argument is right here in this third pattern that I'd like you to understand. It's called a contracting triangle. Prices contract and to become narrower and narrower until they finally break out to the upside. And I think that this pattern is playing out in the miners. Here we have GDX on top, the Van Eck Vectors Gold Miner ETF, and on the bottom an index an ETF of silver miners, the Global X Silver ETF SIL. And both of them traced out this contracting triangle pattern that in recent years ended and is now, both of them are advancing again, the gold miners leading the silver miners as they do to the upside. And it's a powerful move that is probably unfolding at present in this third wave. And the third waves in a 5-wave sequence tend to be the most powerful of the bunch. So as long as prices do not, again, I really think that gold is extending higher, and it's going to ignore that momentum divergence. And I think that this pattern is supporting that, because the miners, there are other ways to interpret this sideways pattern that it's done over the past couple decades, but I think the best one at this point is a third wave advance that's going to basically lead eventually, that this impulsive or 5-wave pattern will eventually lead to new all-time highs as part of my bullish thesis for gold overall. So that's our discussion of the miners. Unless you have any other discussion or questions about gold or miners in particular, I'd like to talk about the second half, or rather the first half of my thesis, which is the end of the infotech era.
I got one question on gold and commodities.
Yeah,
do you believe that gold, for it to be a strong commodity bull market, this might be a fundamental question that you might say, Bill, I'm not looking at fundamentals, but do you believe that gold has to strongly lead the whole commodity complex for there to be a commodity run?
It's not that I believe that it's necessary. I believe that the fact that gold is leading the commodity sector is inflationary. And so...
And you see this upcoming breakout in both charts, in gold and commodities.
Well, okay, commodities, as you saw earlier, the Bloomberg Commodity Index, or you can look at any ETF such as DBC. That's the one I usually go to. Um, it they are declining right at present, and they may actually continue to decline. But this is mainly being brought down by energy, for example, which has been very weak. Oil. I wouldn't be surprised to see the commodity these broad commodity indexes continue to decline for several more months. They may bottom soon. They may actually have bottomed already. I'm not quite sure about that yet. But the bigger picture is not so much what happens in the short term to commodities, but rather the long-term structure, which I showed you. And if you take a chart of gold and say the Bloomberg Commodity Index, they're not going to necessarily ebb and flow with each other, right? There's some will go up, one will go up while the other goes down. But over the long term, and this is what we're concerned with here, you will look back, decades from now and say, yeah, that was a commodity bull market and gold was leading it the entire time, or at least, certainly in the beginning part of it. So no, it's not a requirement, and neither does the fact that commodities and oil, in particular energy, have been declining recently. That does not at all negate my long-term thesis. In fact, it simply supports the wave 2 pullback in the Bloomberg Commodity Index. But those long-term patterns in, for example, the Bloomberg Commodity Index can be different from the long-term patterns in gold. But what's happening at this period of history is that they're about to align with each other, I think. In other words, in this strong bull market, which I foresee over the next several years, if not decade.
Mark, one more question before you move on with the presentation. So we're analyzing and identifying that a bottom has occurred and you expect a nice run. How do you identify tops? Do you just invert this paradigm to identify cyclical tops?
Exactly. And so, like, for example, I will be looking for a top in gold when this developing five-wave pattern that we see here on the screen, when it completes. So right now we're in the middle of it, right? We've been advancing, for a few years now, and you can expect that we're only in the middle of it. In fact, probably not even the middle of the middle, the exact middle, which means that if gold has been advancing for a few years already, this intermediate term trend will probably continue to advance for a few more years, because we're not even in the midpoint of it yet. And so when we get to that, wave 5, I'll give you a hint, typically does show and that is my concern. If we can go back, for example, to the near-term chart, right? My concern about gold in the near term is potentially that we've had, for example, a 1, 2, 3, 4, 5 wave advance, and that we're coming to the end of that, because sometimes fifth waves do end on momentum divergences, and that's what we're looking at here. But I'm not even going to label that right now, because I'm not even often these momentum divergences fail and they just continue going, in which case we've got potentially a third of a third of a third wave, which is the most powerful pattern that we've got in our book. And that I believe that's what's going on here, but yes, and especially when combined with the short-term view of looking at these. I mean, why would gold be topping when GDX and SIL are about to explode to the upside in the third wave? It just doesn't make any sense. So the better interpretation is probably that gold is also exploding in a third of a third wave, continuing to lead the miners higher. And eventually that may swap. We may see, for example, the miners begin to outperform the metals. And that would be probably a bad sign, over the longer term. But we don't see that yet. And I think
in the short term, as a mining speculator, in the short term, you want to see the miners outperform the metal, because that's indicative usually that the metal is going to follow the metal price. But you're saying in the long run, that's a bad thing.
In the long run, right? I mean, because we also know that people can get overly optimistic about the miners, right? And when that happens, when they're really outperforming for an extent, and gold is just not following, then that's where that would be an indication, I think, that because what we're seeing here is the opposite, right? The miners have been underperforming, maybe not in the near term, but in the past few years, the miners have definitely been underperforming, and I think that's a reflection of the fact that people just are not aware of how big this bull market is in gold. They're not willing to bid those miners up because they don't know what's going to happen in the future.
So again, we're explaining this from the template of human psychology as represented in charts, which are indicative of past human psychology.
Right, and present.
And present.
And present, yeah. But yeah, I mean, it's again, people are uncomfortable with patterns in human behavior because it takes away the agency, the ability to have control over your life. But the great thing is, if you understand the patterns, then you can actually take advantage of them. And that's what the promise of Elliott waves. And I think that we're seeing it right here, in both gold and the miners. I think there's a great opportunity immediately ahead.
Thank you for those explanations.
Okay, so so I'd like to then continue on with the first part. I think a lot of your viewers will be interested in what's going to happen to Bitcoin and the NASDAQ 100. For the past 15 years, just to throw in a gold connection, I think a lot of people have been wondering, what is the relationship between Bitcoin and gold, right? They on the surface, they appear to be an alternative currency, something outside the system. For me, I've come to the conclusion that they are simply the leaders of their asset classes, by which I mean tangible and intangible. So Bitcoin has been the leader for the past 15 years of the infotech sector, of digital assets and currencies. And gold, as we've seen in recent years, certainly is the leader of the tangible assets, of the commodities, right? And if you treat them as such, we now have what I'm calling here approaching the end of the intangible assets era, right? Bitcoin has basically ebbed and flowed with the NASDAQ 100, which actually has been tracing out since the year 2002, a 5-wave advance. And here you can see a long and strong third wave, as third waves tend to be. It also, the third wave subdivided into 5 waves itself. And we've since first seen a sell-off, right? And the question is, well, is the NASDAQ 100 done yet? I'm not sure about that yet, because one of the reasons why I'm not sure that the NASDAQ 100 is done, it could easily continue to unfold in this developing 5-wave pattern, is because Bitcoin has yet to fall. But Bitcoin is on the ropes, as we see. This is the lower trend channel line from an Elliott perspective, an Elliott wave perspective. And if we do fall below 75,000 on Bitcoin and we stay down below that level, I think that would be this would be the second domino to fall, so to speak. And we'd have more evidence that the intangible assets infotech sector is pretty much at the end of its rope.
So you link Bitcoin to the infotech sector. You don't link it at all then to faith in government or desire to protect personal privacy, or lack of faith in sovereign currencies?
I think prices rise because they rise. In other words, people get bullish about an asset class simply because the price is rising. They'll do that to anything. They'll do that to flowers, as we know, right? From the tulip bulb experience. And so I hope this doesn't step on anyone's toes, but personally, I think that there is no value to Bitcoin. I think there's great value in blockchain, but Bitcoin itself doesn't have much value, certainly as a store of value. And it's a very expensive mechanism as a transaction mechanism. So I think that the fact that Bitcoin traces out such a beautiful 5-wave pattern from an Elliott wave, for me and for us, I can speak for the company, this actually justifies our view that human psychology is the main driver of price trends in financial markets. This asset class, this Bitcoin, has absolutely no fundamentals to speak of. And yet it has ebbed and flowed in Elliott wave patterns beautifully. And it's actually, we may actually be looking at a point that we're very close to the end of this entire 5-wave pattern, as it is in the NASDAQ 100. So there is an argument to be made that digital assets, that cryptocurrencies can play a role in the future. But from our perspective, we're just concerned with what is the five-way pattern? What does that mean for the future? When this five-way pattern is done, as it may already be, although until it breaks that uptrend line, I'm pretty much bullish, and yeah, I'm assuming it's going to continue higher, as may the Nasdaq 100. Once that pattern ends, you're going to see the largest correction in Bitcoin that it has experienced, much like you're going to see the largest correction in the Nasdaq 100 that it has experienced over the past a few decades.
So
from
you're
that 2002 low.
Mark, for those that point out Bitcoin as digital gold, you're essentially saying we're going to see a stark divergence between the gold price and where the Bitcoin price goes.
Exactly. I am drawing a clear distinction between Bitcoin as the leader of the intangible assets sector and gold as the leader of the tangible assets sector. And we are my thesis is that we're transferring, or we're transitioning between the two eras, between the intangible assets era, which has been the dominant investment venue, for the past 15 years, and the tangible assets, which are being led by gold. I am completely in the gold camp on that. And I personally am not. I don't necessarily care about any of these assets. I'm not emotionally attached to them. All I am is a technical analyst looking at long-term patterns and coming to macroeconomic conclusions based on those patterns. I'm not a lover of Bitcoin, and neither am I a lover of gold necessarily, but I recognize these trends, and I'm saying that that gold has a far brighter future than Bitcoin over the next decade.
Thank you for that explanation.
Okay. And so that's the basic thesis there on infotech assets. Let's go back to the second part of the thesis, and that is the rise of emerging markets, if we can, for a minute. Here is the long-term chart showing the MSCI Emerging Markets Index and the Bloomberg Commodity Index on the bottom. You can see that obviously emerging market stocks have outperformed commodities by far over the decades, but the important point here is that they tend to ebb and flow together, these two assets, over time. And so if we're going to be forecasting a very large wave 3 advance, to continue in the future over decades, then I think that the emerging markets stocks are also going to go along for that ride. And actually here with the MSCI Emerging Markets Index.
So is that a fundamental? Is that a fundamental argument you just made? If I see it, or are you saying I see in the Bloomberg Commodity Index chart a rise, therefore the related move will be in the emerging markets? I guess. Are you making a fundamental argument from looking at a chart?
You caught me there.
Okay,
very good, and okay. I'm glad you did. I mean, yes, the truth is that these emerging markets are, they're primarily based around exports of raw materials, and that's what the Bloomberg Commodity Index represents. So, but it's not that one is going to cause the other, to go up. I just think that, that's their business. I mean, their businesses are based on raw materials, and so. But in terms of timing the market, I'm not saying that any particular move at any particular. I mean, you can see, for example, just in the past few years, commodities have been declining while emerging markets have been rising, right, along this lower trend channel line. So it's not that it's a one-to-one relationship. You can't time emerging markets based on the price of oil or even the commodity index overall. But over time, you will see that there is a relationship. Is that a fundamental relationship, a fundamental argument? You may have me there a little bit, but I'm not going to give in yet. It's from a timing perspective or from a wave pattern perspective, I don't think that there's a one-to-one relationship. It's rather that over time there does seem to be a relationship.
Thank you for that explanation.
Okay, and so my bullishness on emerging markets is not just on an absolute basis that emerging markets are going to rise during the commodity bull market, but also its relative performance. For example, against U.S. assets. Here I've got the MSCI Emerging Markets Index divided by the S&P 500 Index, a ratio with a historical extension provided by the Bank of America. You can see that, over the past 15 years, the S&P 500 has just been crushing emerging markets, which is why the ratio, the line has been declining. But you can see that over decades, there are long periods when emerging markets have been crushing the S&P 500. So there's a good precedent for opportunities in emerging markets just in this single ratio chart. And to support that argument as to why I think you may say, okay, Mark, why do you believe that emerging markets are going to outperform now? There's, it's true that this ratio can continue declining as it did back here in the 60s to much lower levels. But I believe I have a means of timing this upturn because the relationship between the performance of the U.S. dollar and outperformance by U.S. stocks, in this case the S&P 500, seems to be pretty tight. We've seen three major periods of what has recently been called U.S. asset or U.S. dollar exceptionalism. And the past 15 years has been a great example of that. Here, the U.S. dollar has been rising and the S&P has basically been crushing everything else. And that was true back in the late 90s here and during the early 1980s as well. As we saw, the U.S. dollar index performance was actually a very good indication of the outperformance by U.S. stocks and U.S. assets overall. So the question is now, why then, Mark, do you believe that, that this, that the S&P 500 is going to underperform? Why is the U.S. at the period of U.S. asset exceptionalism? Why is it ending? And that's because I have a means, I believe, of timing the end of the U.S. dollar index, the advance in the U.S. dollar index. And here we have. You can see from this is the U.S. dollar index on top, from the low in 2008, a five-wave advancing pattern that ended in 2022, right? The subwave, wave 3, subdivided into 5 waves itself. And we've since, traced out a corrective period that I believe is either wave 1 or wave A down and wave 2 or wave B up. And again, I was introducing my thesis about the end of the infotech era and the rise of emerging markets at the end of 2024 in expectation that we would get a collapse in the U.S. dollar. And that was based not only on this pattern here, which has since nicely continued down, but also on this pattern down here in the Deutsche Bank Emerging Markets Foreign Exchange Dynamically Weighted Spot Index, basically an EM currency index, which is ending a 5-wave pattern called an ending diagonal. And I'm not sure necessarily if it has ended already. I believe it has in early 2025, but it could go down a little bit further even. But regardless, the combination of these two patterns, the end of these 5-wave patterns in both of these indexes, is pretty bearish for the U.S. dollar. And I think that many of your viewers probably remember this cover of the Economist. They published this report on America's economy, right? They called it the envy of the world, but they chose as their symbol of America's economy a rocketing roll of U.S. dollar notes. And I think that's an excellent symbol because as we saw earlier, right, that the outperformance by the U.S. dollar is actually a good indication of the outperformance by U.S. assets overall. And therefore, I think, I'm sure a lot of your readers would agree that we have to consider this from a contrarian perspective. Certainly, it happened before this wave B high or this wave 2 high, and before the end of the decline in the EM currency index. We have to interpret it from a contrarian index.
Donald Trump would not agree with you on this perspective.
Donald Trump would not agree with me, although I'm sure he's probably open to making U.S. products more competitive by seeing the dollar decline. I'm simply saying, and I was saying this before we knew the results of the election, if Kamala Harris had been elected president, we would still see a massive sell-off in the U.S. dollar over the next several years. And I believe that we're still seeing this decline. It has nothing to do with the politics. It has to do with the pattern.
But he would not want to see emerging markets outperform American industry, which is what he's trying to deal with right now with his tariff approach. And I know we're talking fundamentals and politics, but I'm just kind of pointing out that what you're explaining doesn't 100% coincide with what the current president of the United States, his hopes for the American economy.
Hopes for the American economy, yes, but again, this is another reason why I think that why we as a company at Elliott Wave International, we think that the technical perspective on financial markets is far superior to the fundamental one, right? How many people bought the U.S. dollar after Trump's election, right, in November last year? You got and how many hedge funds were buying into U.S. dollar futures, thinking that it would continue to rise? Because and remember what the narrative was back then. This is extraordinary. The narrative was that tariffs would be bullish for the U.S. dollar. And now that Trump is actually imposing those tariffs, the U.S. dollar is selling off. So where then is the logic? Was that narrative ever correct? Or rather, and this is the alternative view, and this is our view, there wasn't any. It's not that the U.S. dollar was rising because of it rose 6% after his election over the next 2 months. It's not that the U.S. dollar was rising because of the tariffs or the prospects of the imposition of tariffs, nor is it now that the U.S. dollar is selling off because of the tariffs. Rather, it simply needed that this U.S. dollar index, in this case, needed to complete that corrective pattern, which frankly, from this low over here is A, B, and C. And that's what I was expecting at that time. That's, again, I'm not sure if this is wave 1 down and then wave 2 up, or wave A, B, and then we're now heading in wave C down for a while. Not sure about that yet. But the point is, on that near term, I had an A, B, C advance that was completing, and I knew it. And so it was actually hilarious to watch the news. This is what journalists do. They rationalize the price index by coming up with some fundamental justification for it. And they say, well, okay, well, why is the dollar rising after Trump's election? Oh, it must be because of Trump's policies, right? What's he going to do? Oh, yeah, he's going to impose tariffs. Oh, well, then tariffs must be bullish for the dollar. That's why the dollar's rising. That's what these journalists are doing. They're coming up with rationalizations based on the price action. But they actually, there is the primary driver of these financial market trends are not the fundamentals. They are simply the patterns themselves. And the narratives change based on the price action. And the past few months is a perfect example of that.
So you don't believe narrative drives price. You believe price drives narrative.
Price drives narrative. That's correct. Yep. That's correct. And so, for example, and the past several months are a great example. Again, the narrative was that the tariffs are going to be bullish, and that's why the dollar is rising. Now that the tariffs are actually being imposed, the dollar is selling off. Neither of these narratives was correct to begin with. The only thing that was correct, and the only logic in this entire, the past several months, has been the price pattern itself. And that's why we at Elliott Wave International trust the patterns, not the news. The news, if anything, it will, sometimes news does actually reflect, in other words, you can have major political announcements made at peaks, for example, right? That's a sentiment indicator, if nothing, at best. But really, you need to watch the price action, watch the patterns, rather than what you believe is going to happen. And that's, at a longer term perspective, you are completely correct. I am forecasting a lost decade, possibly 2, for the United States, based on that long-term pattern that you saw in the NASDAQ 100 index. I'm also forecasting a lost decade for Bitcoin and cryptocurrencies. This is a massive forecast, but I'm doing it based on the patterns alone. I have no idea what the fundamentals, what fundamentals will fall in line to actually, execute that pattern. Or it's not the pattern, it's not the fundamentals that are causing the pattern. It's rather the fundamentals will eventually reflect the pattern, because, as we know, fundamentals lag price moves by several months. But we believe that's because the psychology actually changes. So if Bitcoin is going to collapse, you will see people become bearish on Bitcoin. They'll start selling, and and that will build on itself. And it's just all part of the psychology is part of the pattern. The psychology is driving the pattern. I know that sounds complicated, and I'm sure there's. I hope you're going to get a lot of chat.
I would just point out one thing for listeners, because I know people get emotionally attached to their investments. They get emotionally attached to their theses. And what you're saying, which I agree with, is that don't get emotionally attached whatsoever. Look at the facts. You're applying a paradigm, right? And to be intellectually honest, you have to say there are assumptions built into my paradigm. However, I think this paradigm is the most accurate in terms of my looking at history and how I've applied this paradigm, I think it's the best thing I can use to, and correct me if I'm wrong, but I'm articulating what I'm hearing from you. This paradigm helps me see what's coming the best, okay? But there are assumptions that any paradigm, any thesis is going to have assumptions built into it. But if you get upset or offended because an analyst shares an opinion, you better check yourself before you wreck yourself, to quote a famous philosopher, because you're not going to be making right decisions, because it's not driven by intellect, it's driven by emotions.
That's correct. Completely correct. I have chosen a methodology. It's called Elliott wave analysis, and it's purely technical. It incorporates no fundamental assumptions, no political assumptions, no policy assumptions. This is completely independent of any of that. And from that, I'm concluding that we're heading into a lost decade in the United States. Doesn't matter who's president, doesn't matter what his or her policies are. And that's the beauty of this thing. You're completely independent of all of that outside influence. I would call it noise.
Mark, but you would say, like, obviously I'm American, right? The majority of my family lives in America. So, like, I don't want to hear America might not prosper as much in the next, whatever, you said could be multiple decades, right? However, would you at the same time be able to see micro or smaller profit opportunities within a lost decade of America, within America, or do you primarily look to the emerging markets?
Well, the bear market ahead is going to have bear market rallies, and they're going to be huge, and they're going to be fierce. So yeah, within those bear market rallies, you will have
or subsectors,
long side opportunities. You can, if you really want to take a risk, you can try short side opportunities. But I'm sorry, I didn't hear you again.
Like subsectors, are there like AI, artificial intelligence? Just to throw one out there. Like, even when you see the macro trend overall, have you identified, and you don't have to go too far into it if you don't want to, have you identified maybe some subsectors that may be primed from the Elliott wave perspective bullishly, even if overall American industry, you're referencing it as a lost decade?
Well, picking the winners, especially during a bear market, is extremely difficult. And I would also say that it's way too early, because I don't even have confirmation that the NASDAQ 100 has ended its 5-wave advance from 2002. Once we have that, and I would say that we need the second domino, Bitcoin, to fall before I'm confident that we've got a bear market immediately ahead. Right now, I'd actually be interested in looking at some leading positions in the infotech sector, for example. There's still some companies out there. I'm looking, I can give you some individual names that are on the list. Look at Palantir, CrowdStrike. Some of these companies could actually ride another wave up over the next several months, even over the next year. But that would require a pretty solid a continuation of the bull market in the NASDAQ 100, or at least a good bear market rally in the near term. Bitcoin, I'm still bullish on Bitcoin right now because it hasn't broken that downtrend line. But as far as during the bear market, one of the reasons why I'm pushing emerging markets so heavily is because I think they are going to be the key to outperformance during the commodity bull market. And so if you're looking for opportunities, fine, maybe maybe you don't have to look at China, for example, but you can look at plenty of other emerging markets in Latin America, for example, that can be much more politically palatable to many people for opportunities to survive and thrive during the bear market in U.S. assets.
Thank you for engaging that tangential question. I appreciate that.
Yeah, no problem. I think actually it's a great question. But yeah, actually, if I can play on it a little bit more, yeah, there are people who do get attached, and I'm sure that I'm going to get a lot of hateful comments. We're talking about the coming lost decade in the United States, especially since many people
and you
do
said
believe
Bitcoin has no fundamentals, if I recall what you said too, right?
Correct.
Yeah.
It is zero.
I know people, friends that would vehemently disagree with you.
Disagree with that,
Yeah.
Of course. Yeah. I would say it's got less than tulips did, back in the early 1700s.
Ouch.
Yeah. So that's but anyway, it doesn't matter actually what I think about fundamentals because, again, I'm a technical analyst. I'm purely focused on the price action. And, you can take all your fundamentals with Bitcoin, but if we break below 75,000, I've got to put my chips on the coming bear market. Even though I'm bullish in the near term on Bitcoin right now. So again, I just think that you're so much better off treating financial markets and viewing them from a purely technical perspective than you are, investing yourself emotionally in the fundamentals or the narrative. Because as we've seen just with the US dollar alone in the past few months, that narrative didn't play out. The narrative was worthless. Those hedge funds who were piling into the US dollar just earlier this year in January or so, they're crying right now. What use was it to be wedded to that narrative? None. It was defeatist, if anything. So it's far better to use the technical perspective.
Thank you for that clarity. Shall we move on with the presentation? Do we have any more slides?
Okay. Yeah. Right. So I kind of hinted at it before. Again, if the U.S. dollar and the U.S. asset exceptionalism era is ending, what then might be replacing it? What's going to be the outperformer of the future? And I think this is the question we alluded to it earlier that's going to make a lot of people uncomfortable. I think that emerging markets overall are one option. But I think actually China is one to look at, as the potential leader, and I'll show you why. Here we have the Shanghai Composite making a contracting triangle pattern, A, B, C, D, E. It ended it in early 2024, and it's since been tracing out a series of first and second waves in what I believe is a new bull market that's going to new all-time highs and beyond in coming years. And in supportive of that, again, we saw how the U.S. dollar was in a good indication of the strength of the U.S. stock market and U.S. assets for the past 15 years. Well, consider the Chinese yuan, right? If it has traced out, as I believe it has, wave 1 up and wave 2 down, again, impulses tend to be fairly clean, as this is, and corrective waves tend to be choppy, which this is. This is a component, the Chinese yuan is a component of the Deutsche Bank Emerging Markets Currency Index, and you can see that it is just like that index, ending a corrective pattern or a five-way pattern here. And I think that it may continue down a little bit further, but basically the next big move in the yuan is going to be to the upside in a large third wave that will last potentially for decades, and that will underline the just like the U.S. dollar advance underlying was an indicator of U.S. asset outperformance. I think that you'll see the yuan, the Chinese currency, underline basically Chinese asset outperformance going forward during this wave 5 advance. And to make a comparison, this is an analogy I've come up with to the Japanese yen during the 1980s, right? Here, the Japanese yen traced out a 5-wave decline here, and by 1982, it was on the ropes, it seemed, just like the Chinese yuan appears to be at present as well. But the Japanese yen reversed on a dime in 1982, and it went the opposite direction. It soared. Again, it was the up-and-coming manufacturer, as China has basically revealed itself to be in recent decades. And the yen, if you had purchased the yen, or rather, if you had purchased the Japanese stock market in 1982, you would have absolutely outperformed the rest of the world over the next decade, not just because you had the best performing stock market in nominal terms, but because you had the best performing currency at the time. And so your gains in US dollar terms would be compounded. And I think a similar thing may be happening with the Chinese currency at present. You've got if this reversal does occur, and it's going to occur in line with the emerging markets currency index that we looked at, we should see over the next certainly 10 years, if not next few decades, a much stronger yuan falling under the 4 level for yuan per dollar in the future, and that would be a good indication of the strength of the Chinese assets overall. And again, that probably makes people uncomfortable, but look, the parallels are there. You've got the world's dominant manufacturer, or at least most innovative manufacturer, much like the Japanese were putting out the cars that Americans wanted to buy throughout the 70s and 80s and so on. The Chinese are innovative in coming up with the automobiles of the future. even exceeding Tesla in many cases, certainly in terms of battery technology. So that's basically the end of my thesis. You can take this China aspect of it, with a grain of salt if you'd like, because there's many opportunities in emerging markets outside of China if you'd like to avoid it. But I'm just looking at historical trends and certainly patterns and trying to put two and two together to come up with a thesis that I think makes sense. And I think I've got it. So
emerging markets and gold are the place to be.
Emerging markets and gold. Yeah, you're probably fine just with the metals alone. But if you'd like to diversify, well, come and check out my publication, my newsletter. By the way, this is the end of my presentation. This is my newsletter and the Asian Pacific Financial Forecast, where I do discuss a lot of opportunities in emerging markets in addition to Asia and certainly China. But if you'd like to learn more about Elliott Waves and our products, you can go to elliottwave.com. You can see there /MSE. We've got a special greeting page for any of your listeners from MiningStockEducation.com. If they'd like to come and check it out, we can give you some free material that they can download from our Global Market Perspective, which is actually the parent publication to my publication. It includes stocks, bonds, currencies, and so on. All asset classes. And thank you very much for your time, Bill. And
thank you, Mark.
If you have any other questions.
And for listeners, this interview was not sponsored. I have no partner sharing or any business relationship with Elliott Wave. So if you go to that customized link, it's for your own benefit to check it out if you like what you heard, but I have no financial interest either way. So Mark, this has been a great conversation. I've really enjoyed engaging your perspective, and obviously I'm going to listen to this presentation again and think through some of my own macro theses that affect my investing. So thank you for coming on the show today.
Okay, thank you, Bill.